Let's face it, in the real world, selling is brutal. You might have the best product in your hands, but until someone buys it, it's worth nothing. First, the reluctant door. You call, you email, you knock. 9 out of 10 times, slammed shut even before we begin. Next, the suspicion wall. Customers doubt you. Is this worth my money? Is this another scam? Breaking the wall feels impossible. Third, the competition flood. You are just another voice, shouting cheaper, faster, and louder than the rest of the crowd, but still fail to get heard. But here's the twist. In F&O, you are not just a seller chasing commission. You are also an insurance service provider. That means your mindset can't stop at just sales. You have to think like an entrepreneur. Because every contract you sell carries a promise. If the market there is a claim, you are the one who pays. So the game isn't about quick profits. It's about building a system, managing risk, and playing the long game. Today, we will be discussing a short triangle position taken with the underlying as Nifty and discuss the same scenario from the perspective of a novice trader and to that of a seasoned trader.
Today's discussion shall be a part of the market analysis and tools, strategy and product knowledge, risk and psychology aspects of the foundations required for a financial flywheel through capital mastery. The current market price of Nifty is 24,500. Let us take two contracts, one put option and one call option, both expiring on 9 September. So 9 September means it will be 11 days. We are using a Sensible as a strategy builder. So notice that when you sell these two contracts, these are like 1,000 points away from the current market price, and they would be offering you a premium of 1,526 rupees. So in essence, what has just happened is we have locked funds of 1.73 lakhs and we are getting a premium of 1,526 upfront. So as time passes by, you would notice that the premium values would deteriorate as long as the Nifty stays within this 1,000 point region and is not volatile. By 9 September, even if the market is volatile, as long as it doesn't cross these strike prices of 23,500 and 25,500, this entire money will be in our pocket. So in effect, we have found a way to sell insurance premiums when there is nobody to make a claim. That is, when the strike price stays between 23,500 and 25,500 and the market expires well within that range. Notice that the payoff chart indicates that the current model is well within 2 standard deviations, which is a good thing. However, we should also bear in mind that in the case of the long tails, that is after 2 standard deviation, over here if you notice, the losses are significant, 27,000 and 34,000. For the hypothetical straddle just created, let us discuss the psychology as well as the strategy from the eyes of a novice trader versus that of a seasoned and experienced trader.
The psychology of a novice trader is simple and dangerous. He only sees the happy case scenario. He assumes the market will expire neatly within 2 standard deviations. And he never even considers what lies beyond. But an experienced trader knows better. He plans not just for the expected, but for the unthinkable. The rare, low probability, high impact events. The 5 sigma shocks, the black swan storms, the events that rewrite history books. Remember COVID? The novice dreams of sunshine. The professional carries an umbrella, a raincoat, and an evacuation plan. That's the difference. One trades with hope, the other trades with preparedness.
The strategy of a novice trader is to focus only on the funds required, premiums collected, and the probability of profit. In the case of Sensible, The tool already indicates a probability of profit of 93%. Funds required for taking the position as 1.73 lakh INR. The premium collected as 1526 INR. And basing on the contract expiry date, the number of days of the contract to expire is 11 days. This novice trader will calculate the CAGR based on this data and feel happy about it. Now, unfortunately, if a black swan event were to occur, he will lose irrecoverably and would either stop trading totally, calling futures and options as one big gambling ring, or worse, blame it on his luck and pump in fresh funds and take in even more risk to cover the loss by scaling up the lots. Now, a seasoned trader will look deeper. The questions he would ask is, what happens when the market tests one side of the position? What's the plan if the premium on the tested side doubles or even triples against you? How will I manage a sudden gap up or gap down that turns into a heavy loss? Should I place a hedge right from the start and convert the short strangle to that of an iron condor? And most importantly, how many happy case scenarios are needed just to compensate for one bad case scenario? Is the ratio of happy case versus bad case even acceptable? So, if there is a black swan event, he already knows a priori what the implications are beforehand, and thus would have been well accepted ratio that he can recover. So overall, the difference between a novice trader and a seasoned trader is the novice trader only strategizes for comfort on the basis of hope. The seasoned trader plans for survival based on possibilities.
To summarize, we have seen how the very same short strangle can look completely different depending on who is trading it. For the novice, it's simple. Look at the funds, collect the premium, trust the probability, and dream of the happy case. But for the experienced trader, the same model carries a different weight. They don't just see the profit potential, they see risk. They ask questions like, what if the premium doubles? What if it triples? What if the market gaps up overnight? The novice feels comfort, the seasoned trader feels responsibility. And that is the real difference. One plays with hope, the other plays with a plan.